This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss recent market volatility, the AI stock rally of the past few years, and the historically high market valuations. Now, stock market indices have declined in early 2025, while Treasury yields have risen. Part of this recent market pullback can be attributed to a stronger than expected December jobs report, which shifted rate cut expectations to down to just one for 2025. It's still very early in the year, so it's important for investors to maintain a broad perspective since things can change quickly. Over the next few minutes, we'll discuss some of the factors behind the current market conditions. First, market volatility is a normal part of investing. In fact, 2024 also began with a similar pullback that turned into a strong rally. After 2 strong years for the stock market, it's natural to see the market fluctuate. As this chart shows, market pullbacks are common even in years of great returns. Long-term investors can even benefit from these market swings as they adjust and rebalance their portfolios at the start of the year. So investors should obviously not overreact to the market being down only for a few trading days. Next, this chart shows the incredible trajectory of the Magnificent Seven, a group of high-performing tech stocks which have driven market gains over the past couple of years. The Magnificent Seven have grown 250% since 2023 and 500% since 2020, largely due to the trends in artificial intelligence. Now, these stocks face risks from interest rate changes since their valuations depend heavily on future earnings expectations. Due to market cap weighting, the Magnificent Seven's strong performance can lead to overconcentration in portfolios, especially in those market cap weighted strategies like the S&P 500, thus potentially reducing diversification benefits. This means that long-term investors should carefully consider and review their asset allocations. While there are many reasons tech stocks continue to be attractive, it's important to benefit from other parts of the market as well. After all, by definition, that is what diversification is supposed to be. As I've said many times, if everything in your portfolio is going up at the same time, it usually means everything will go down at the same time. Finally, this chart shows the price to earnings ratio for the S&P 500 using forward earnings estimates for the next 12 months. As you can see, valuations have increased substantially as a result of the market's strong rally. At 21.5 times, the S&P 500's PE ratio is approaching the dot-com bubble peak of 24.5 times. In fact, some investors are beginning to ask whether or not we are in a stock market bubble today. Despite these high valuations, today's environment is different. Economic fundamentals remain strong, with steady growth, a robust job market, and healthy corporate earnings. Many of the technology stocks that have rallied have strong earnings growth. This highlights the importance of maintaining portfolio balance across different market sectors and investment styles and approaches, as anything is possible, both positive or negative. As I've said in the past, the old adage, it's the bus you don't see coming that hits you. It's simple. If you see the bus coming, you get out of the way. It's the unknown that's impossible to predict. That's why we focus on preparation over prediction. We encourage folks to stop attempting to predict or focused on year-end targets of the stock market, which are historically wrong, by the way. Instead, build a robust portfolio utilizing a multidimensional asset allocation approach. Now, we hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click on the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.